computer. Okay. Yes, we are recording. Hi, I'm Cindy Antonio. I am your Salary and Benefits Chairperson. I am an elected official. Rita, who is also here, is my assistant. She's waving very nicely. She's also one of the other co-hosts, if you look at our names. Rita is the person who sends out like all my RSVPs and everything, and I do appreciate it. Rita and I are both 100% remote. We went into the CTU office back in July and grabbed everything we needed to grab to do our job at home for the rest of this semester. So we are 100% remote. We do not plan on really going back into the office until January. So being that we have gifts that we will be sending you in January for thanking you for coming to our event. So if you get additional emails from us, we do appreciate it. We have a little bit of a packed house. Rita had close to, 40 people. How many people did we have? About 40? She needs to unmute herself.
Close to 80.
Close to 80. Okay, so we had close to 80 people sign up for this. And we know that signing up versus actually coming can be two different things. So we do want to thank the 30 people that are here with us, and more people will be coming. We will do a Q&A session at the end. So you can have those ready to go at the very end. Once we start the Q&A session, I will stop the recording so people can talk a little bit more openly with that. I do appreciate it. If there's any kind of handouts from CMSD that I need to send out about retirements, I will send them out to union chairs and then they will forward them. If you don't get the handout by like next week, Friday, please just email me because I'll send it out to you. I know this is a very challenging year for all of us, and we are doing the best we can. You are here to understand the ins and outs of retirement. We are going to start with STRS. If you are a para and you are under SERS or OPERS, I have reached out to them and I have not heard anything back. So as soon as I hear back from them about retirement information, I would forward it over to you. So where did my, oh, there you are. Okay, Ms. Cole, you have the floor. You are my STRS representative.
Hello, everyone. Bear with me here while I pull everything up.
To give her an idea of, to give her an idea of how many of who's here, I am going to launch a real quick poll question just so people can kind of see how many years we are planning on retiring. So there should be a poll question up on your screen. How soon do you see yourself retiring from CMSD? You are not committed to anything by answering this poll question. Are you thinking this year? Are you thinking about 2 or 3 years? Are you thinking 4 to 5 years? Or are you like me and got the date that I'm retiring, July 1st, 2033. Yes, you heard me right, 2033. So are you like me, more than 5 years away? Hey, I'm going to end the poll. I'm going to share the results so everybody can kind of see. So we have a nice mix. Some of us are thinking this year, while others of us are thinking about in 2 or 3 years. So thank you all. And I have my small group of 4 to 5 years, and Rita and I, who are in the more than 5-year group. So, okay. Sorry, Ms. Cole, go ahead and take it away.
That's okay. Can everyone see my screen here?
Yep.
Okay, perfect. Results are definitely going to be helpful here. So I'm going to just kind of highlight what we'll cover. We'll take a look at eligibility specific to what you need to retire with full benefits versus a reduced benefit. We've had a lot of conversation around STRS, specifically with members about early retirement. So not all of it necessarily tied to the pandemic, but nonetheless, you want to be aware of the impact that has financially. We'll then take a look at your final average salary, And then the payout options, then start closing things out with knowing your numbers and key considerations for retirement. So basically your STRS benefit consists of 3 elements. We talk about service credit, which could include purchasable credit. It can include joint credit, meaning you are not just a member of STRS, but you are also a member of OPERS or school employee retirement system. Second element would be your final average salary. And the third one is going to be your plan of payment. That is going to equate to what is coming to you via mail or in the bank. So looking at eligibility in terms of what we refer to full retirement or an unreduced benefit, that simply means that for every year of service, you will receive a 2.2% multiplier. So for full benefits, you would either have to be age 65 with at least 5 years. If you have 33 years, age does not matter. And then that is going to change. So while 33 represents the magic number, it would only be the magic number until July of 2021. Starting August of next year, that 33 will increase to 34. Again, the key is 34 years where age does not matter. It will rest there for a 2-year period, and then it will increase to 35 years where again, age does not matter, and it will stay there for a 3-year stretch. But beginning August 1st of 2026, you will be required to have not just 35 years, but you must also be at least age 60. So there will be what we call a moving target for that unreduced benefit. But just recognize if you will hit 35 years around 2026, the key is making sure that if it is after August 1st, you are looking at needing 35 years with at least age 60. So again, for some, don't panic if you say, hey, I'll have 35 years, but I'll only be 57. I'll cover what a reduced benefit means shortly. So this just gives you an example in terms of that service credit, and that percent is what you receive of your final average salary. So looking at a reduced benefit. A reduced benefit speaks to you are going to take an actuarial reduction in what you receive monthly to account for retiring early. I normally equate it to, if you think in terms of Social Security. Social Security has an early retirement age of 62. Well, STRS has one as well. And that would be having 30 years regardless of age. If you are at least age 60 and you have a minimum of 5 years, you are eligible for a reduced benefit. And then you have the ability to retire if you are at least age 55 and have 28 years. That 28, very similar to an unreduced benefit, will also move starting August 2021. That 28 years becomes 29. So you would either be 55 with 29 years or age 60 with 5, or again, having at least 30 years. Starting August of 2023, the ability to retire under the age of 60 or with less than 30 years will be no more. And this just gives you an example in terms of what early retirement means. 30 years based on someone retiring next year would be 42.24% of their final average salary. That's quite a bit of income to make up when you compare that to what it would be if someone had a full benefit at 2.2%. So when you're looking at your payout options, just to kind of give you again a recap, you're looking at a percent of your final average salary, which equates to an average of your 5 highest years. If you've heard the statement, it's an average of your last 5 years. That's not necessarily required. That's your typical scenario, but that is not a requirement. STRS is looking for an average of your 5 high years, regardless of when they occur. That then boils down to what we call a single life annuity. So think of your annual statement. You receive something usually around this time every year that gives you the various projections. Those are always based on what we call a gross single life annuity benefit. You have an option, however, to take a reduction in your monthly amount to secure what we call a joint and survivor benefit, and then also annuity certain. And then we'll of course talk about the impact of partial lump sum option payment or PLOP. That means at the time of retirement, you have an option to extract part of the account value and still collect monthly. Of course, keeping in mind there are tax implications if you are taking a lump sum payment directly, but ideally you'll want to consider rolling that over to avoid any tax implications. So don't be alarmed. I know this is very small, so I'm going to actually just pass right past this. This is actually what we call as an estimate. It gives you somewhat of a snapshot of what that looks like if you have not contacted STRS to run your individual scenarios. So this is a little bit better for those of us, I don't have my glasses on and probably should. For those of us who are visually challenged, this again, hopefully is something that you can see. But I mentioned single life annuity. I normally say put a star by this particular plan of payment because it is what we call the foundation plan of payment, because everything else that I'll discuss branches off of this figure. So in this particular example, it's using someone who is married and they're using their spouse as the primary beneficiary. But in this case, if they were to choose single life annuity, their monthly amount would be $3,630 based on 33 years. That's 72.6% of their final average salary. But you'll notice it says no benefit to survivor. That means upon this individual's death, benefits simply stop. An alternative, should someone want to protect a loved one financially, in this sample, the individual is going to consider joint and survivor options, which says not only is it a lifetime benefit for the retiree, but upon their death, it is also a lifetime benefit for their primary beneficiary. You actually have a total of 9 options under joint and survivor annuity. What you see here are 8 options, and I'll speak to the 4th one once I go over just a couple of these options here. But again, this is an example using a spouse, but recognize your beneficiary can be whomever you choose. It could be a spouse, a significant other, it could be a partner, it could be a child, regardless of student status, it could be a sibling. You can designate whomever you choose to receive that continuing benefit upon your death. So you have the option of 1, 2, 3, and again, that's not shown as option 4. Option 1 is going to be same to beneficiary. That simply says upon your death, you leave that primary beneficiary the same amount you were receiving. Option 2 speaks to 1/2, which again, upon your death as the retiree, half of that benefit would be payable to your primary for their lifetime. And then this sample talks about 1/3. So option 3 would be 1/3 to beneficiary. And again, that just simply means 1/3 of the benefit would be payable. So if I were to look a little closer at my options, and I'm going to target same to beneficiary, I have an option 1A, 1B, and a 1C. Just to clarify right out off the top, you have a with reversion versus a without reversion. With reversion simply says, if you were to select a beneficiary and they were to predecease you, you can revert to single life annuity. Why is that significant? Well, the single life annuity was roughly $3,600. If I were to choose option 1A, look at what happens to the monthly amount. I'm taking about an 8.5% reduction to secure that benefit for someone else. If they were to pass away, I can eliminate that reduction and revert to that $3,600 benefit. When you look at your option B and 1C, you'll notice there are no reversion options, but you do pick up what we call a guarantee feature that seeks to protect a secondary beneficiary should something happen to the retiree and the primary beneficiary within that specified window. So I'm just going to target 1C just to kind of give you an idea of how that would work. Let's say I'm the retiree. If I were to select 1C, that says 15 years is guaranteed to be payable. Well, as the retiree, it's for my lifetime. If I pass away as my primary beneficiary, let's say my spouse would receive that for his lifetime. But we have a 10-year-old son. If something were to happen to us after, let's say, 3 years into retirement, unfortunately, let's say we're both in an auto accident and 3 years into my retirement, we both pass away. Well, our survivor is our son. As the beneficiary, STRS would pay him that benefit for 12 years. At the conclusion of that 12-year period, benefits stop. So that is where the guarantee feature comes in under joint and survivor. So you can simply apply that to the remainder, so 1/2 or even looking at 1/3. And I'll talk about the uniqueness of 1/3. But again, the key is the more you leave that primary, the less you take home. If I were to look at the 1/3 option or option 3, you'll notice there are no guarantee features, but you do still have with reversion versus without. But you actually, under option 3, you can change that to either a different fraction or percent, or indicate a specific dollar amount. So if I just wanted to leave $200, I absolutely can do that using option 3, which means my benefit would be slightly higher than the example because I'm leaving them less than 1/3 of my benefit. And then the last option, again, which is not shown, which is option 4, that speaks to multiple primary beneficiaries. You can leave a benefit to up to 4 individuals. Why would someone do that? It just varies. I've only seen it once, and that was due to a divorce. The individual had a court order that said they had to leave their ex-spouse a certain percent upon death, but they were also remarried. So again, if you think in terms of the impact, if I'm asking STRS to leave a benefit for the lifetime of one person, that's going to be quite the reduction if I target 4 individuals. So looking at annuity certain, which would be your last plan of payment option, that is going to simply, again, take into consideration that I'm not looking to leave a lifetime benefit to anyone else. I just maybe want to provide some financial protection should happen to me within a certain window. So if I were to pass away after 15 years in retirement, based on this example, nothing would be payable. I would have to, again, consider that 10-year window starts to tick from the effective retirement date. And then the last thing that you would take a look at or consider is the plop. That is going to be in conjunction with a plan of payment. So if I were to take the minimum plop, that is always 6 times the single life annuity. The maximum plop is going to be 36 times the single life annuity amount. So everyone will have a different minimum and a maximum, but you can absolutely go anywhere in between. But just recognize when you look to the far right, what happens to your monthly dollar amount. It's a reduction to extract part of that money at the time of retirement. And that does not take into consideration the reduction that would apply in the event you want to secure benefits for someone else. So again, I call this the speed bump of retirement because this is a significant financial decision and possibly one that cannot be changed at a later date. So your replacement ratio, depending upon what financial experts you talk to, you want to replace at least 70 to 90% of your working income. So if you have not actually taken a moment to sit down and think what percent of my working income will be taken up using my retirement benefit, you're simply going to take your gross retirement amount and divide it by your gross working income, and that'll give you your replacement ratio. Doesn't mean it's enough, but it at least will give you an idea of where you fall financially. Most experts say to live comfortably or maintain your lifestyle, you'll absolutely want to fall somewhere within that range. Just something as a heads up, if you're someone that's starting to jot that down now, Recognize that if you are looking at your contract salary, let's say your contract salary is $50,000. Recognize that you're really not living off of $50,000. That's your gross working income, but keep in mind, STRS is taking 14% of that. So you're really only living off of 86%. And then there are other things that you are currently having deducted that you would not in retirement. So again, it's a kind of a very refined approach and making sure you know what you're paying today and reconciling that with what you expect to pay or income that you'll have in the future. So that leads us to know your numbers. If you have not met with a benefit estimate, so based on Cindy's survey, it looks like a good number of you are at least within 5 years. Now is the time to absolutely get an estimate from an STRS benefit counselor to kind of sit down and say, okay, here's where I am. It doesn't mean it won't change in terms of you may work longer, you may retire sooner, but you want to run as many scenarios as you need to locate your monthly amount. Second point would be reconciling your expenses and income. That first marker is key. Ideally, if you can live off of just your STRS, you are in good shape. If you have a 403B, a 457, a traditional IRA, you always want another source of retirement income. But if you do not have to tap into it, again, you are in a very good position if you can meet your expenses in retirement with just your STRS benefit. And then looking at healthcare. Again, that's another strong consideration if you are looking at healthcare through STRS and you are under the age of 65. So here's something that, again, I always show, which are those healthcare rates. Being in northeastern part of Ohio, you guys are looking at, for the most part, medical mutual as your only option. So even though you see alt care, that is going to be specific to Stark County and some surrounding areas. Again, it's based on your place of residence. So it's just giving you an idea. Those are some pretty hefty premiums just for the retiree. And if you then look at the spouse premium, that's going to be quite interesting. You're looking at, if I were talking medical mutual, I'm looking at almost $1,500 per month for myself and a non-Medicare spouse. So again, very key in counting the costs before you start to fill out that retirement application. This is with Medicare. So if you are someone that is going to be closer to 65, the good news for you is you can see the drastic drop in rates. Medicare is introduced when you turn 65, and of course that takes a lot of the financial burden off of not just your retirement system, but you as well, because those plans through STRS are much more cost effective, as well as coverage wise, you have a much lower out of pocket via those co-payments, those deductibles, and co-insurance. Here's some key considerations. Finances, I think that's probably a given. Everyone approaching retirement, you're starting to look at those hard numbers of being able to account for not just the major expenses, but start to consider those smaller expenses. Again, those tend to add up and eat away at your budget. Inflation, that's going to be for some of you a huge component, because if you are retiring with STRS, you're probably aware that there is a 5-year deferral before you receive an STRS cost of living adjustment. That being said, the current cost of living is at 0%, which means even on your anniversary date, if nothing else changes for STRS and it's still 0, 5th year anniversary comes and you do not see a change in your monthly benefit amount. That's a big deal. Our oldest member is 108. That's significant. So that individual has been receiving benefits for 56 years, believe it or not, 56 years they've been receiving benefits. If you can think about being in retirement for even 15 years, not having a change in your benefit amount means you're going to be faced with losing purchase power And again, that is huge. That's where those supplemental retirement accounts do come into play, because again, a lot of them can fill in that gap. Health considerations, we're not just talking cost, we're talking health considerations physically, mentally. And the key is making sure that you retire to something. Health experts do speak a lot about filling the void of, if you've been an educator all your life, what are you going to do next? Again, wanting to feel like you're making a difference, whether it's activism, volunteering, reemployment even, you want to make sure you give consideration to that before you make the move. Unexpected events, again, that could be both financially as well as a quality change. It doesn't matter. The idea is you want to kind of think of every scenario. So whether you have to relocate to take care of parents, possibly even take a parent on in terms of they come to live with you. One that's staring us all in the face is the pandemic. Who would have thought that if you were retired, you would be faced with not really knowing what's going to happen, how your dollars are going to grow, and how you're going to make it from year to year. And then, of course, defining your retirement lifestyle. We've talked about the quantitative impact, but you also have to give respect to the qualitative aspect of retirement, meaning what does retirement look like for you specifically? And this just gives you a trail of how to retire. I think out the gate, there's that meet with the benefits counselor, doing your homework in terms of looking at your expenses and income in retirement, whether it's just STRS. Some of you may be eligible for Social Security even. And then you have your employer. Retiring with STRS, somewhat of a separate process, and STRS has nothing to do with payout of sick leave, vacation. And then there's your healthcare again, and then finally submitting that application online. So there's your resources, and that actually concludes, hopefully, I know I went kind of fast, but hopefully that gives you an idea of what you should be considering as you start to approach retirement within 5 years. Again, a very refined approach to making sure you're dotting those I's and crossing those T's. So Cindy, that's really all that I have.
Can you put
So
that?
I don't know
slide?
if there's,
Can you put that?
I'm
last-
sorry.
Can you put that last slide back up there for people so they can capture any of that information that they needed to capture?
Yes, there you go.
Okay, you got to share your screen.
Oh, did I turn it off? I
Yeah.
certainly did. Sorry about that, guys.
So while she's in the
There we
process
go.
of sharing that screen, I cannot say enough for how well STRS has information out there on their website. We're still not seeing it. Please make sure that if you need to get a hold of STRS, that you call any of their numbers. That 188 number, that those people are excellent on that line. I've had to call them a couple times because of viewing my own personal plan. I wanted to see a couple of things. They have all their brochures that we usually get. I know we should have just recently gotten the red brochure in the mail. I just got mine yesterday. All those different brochures that are usually handouts, they are all present there on their website. Please take advantage. Their educational programs, I sat through their healthcare one. It is amazing the resources they have and how they try to be very upfront in educating our members. Please take advantage of it. Write down the toll-free number. Make sure that you do schedule your appointment. Even if you think you're 5 years off, schedule that appointment. They are doing them virtually, so they are safe. They have no plans on going back to the office. I know when her and I were talking, you know, they're like us. They're not thinking of going into the office, back into the office until January. So we are living in this remote world. So if you have any questions for her, she'll stick around to the very end. And thank you. I'm going to hand it over to Dean, if I can find him on my screen. Oh, there he is.
There I am. I'm moving. I keep getting sun coming in through the window, so I keep moving the shades. Cindy, thank you for giving us the opportunity today. My name is Dean Kohler. I'm the district president for AIG Retirement Services, formerly known as VALIC. We've had a relationship since the late 60s with Cleveland Schools. Our advisor that works with Cleveland Schools, Mike Pasek, is also on this Zoom call. This is just always different to do this. I'm not as used to Zoom. We do everything by WebEx, so bear with me if I do it wrong. Today, what we want to do is we're going to discuss the special pay plan, why it exists, what you have to do to get it set up, the rules, all those other things. So here, let me try to share this. And again, my company is, we're, as with everybody, we're all virtual right now. But let me try to make sure I can share the right screen. I'll share screen 3. Can everyone see that?
Yep, you're good.
Okay. It doesn't tell me what I'm sharing or not. So as we go through, the special pay plan, we're going to discuss the role of AIG Retirement Services, again, better known as VALIC. AIG Retirement Services is more of a branding name for the VALIC as a company. Who are we? What is special pay? What are the investments? But really where I wanted to start is the question, when we were allowed to be in schools, when Cindy would hold these events in the auditorium in our building, which was so much better than these virtual calls. I enjoyed getting out and meeting everyone face to face. But the most common question is, why does it exist? Why is Cleveland Schools, why is CTU telling me what I have to do with my money? I'm going to get paid out these unused sick time dollars, incentive dollars, whatever it may be, and I'm being told what I have to do. So we might as well answer that question up front. The reason this plan exists is just because there was a change in law. Prior to 2005, the IRS had always been completely silent on you as employees' ability to voluntarily defer post-separation payouts, whatever they may have been, unused vacation, sick time, incentive if there was that, whatever it was, they'd always been silent. Every school district has their legal team that they hire out, and every school district kind of had some different rules. So in 2005, the IRS basically took away the gray area. And what they said was that unused sick time, unused vacation time was dollars earned, not yet paid out. So those would be fully eligible for voluntary deferral post-separation, provided they were that the deferral occurred within the later of 75 days post-separation or by the end of the same calendar year. Incentive pay was deemed to be dollars not earned but negotiated, so therefore completely ineligible for deferral on a voluntary basis. Well, it was at exactly that same time that Cleveland Schools and the union had negotiated a really nice payout for employees over a 3-year period with, I think it was like 25% of salary and all the other things. Well, the way, because of when that happened, those that retired, I believe as in 06, were ineligible to defer any of those dollars whatsoever. So where did this come from? And I'm going to get into what it is. Why does special pay exist? Well, there was a change in federal law, and Cleveland Schools and Cleveland Teachers Union got together, and they looked at the companies that they had available on the 403B. They looked at the products. They looked at who they trusted to meet with the retiring employees, and going through the due diligence, they chose, and we were very honored to be chosen as the provider for that plan. So that's why it exists, because that seems to be, the most of the question. It was just the IRS changed the rules. So, Cleveland Schools, went, and the union spent some time, in figuring it out. And that's why it was started in 07. You know, what do we as AIG Retirement Services provide? We provide the investments that are available to you, the ongoing education like this. Again, it would be so much better if we could do this face to face where, you know, could have a little bit of food and enjoy ourselves. And we will also provide the help to get to get enrolled in the plan. In the ongoing client service done by our local financial professional, Mike Pasak. And then again, the record keeping, the ongoing statements. You know, I kind of gave a little bit of the background. AIG Retirement Services was the very first company ever in the 403B market. We started, in 1964 in Dade County, Florida. We signed the very first teacher to ever sign up for a 403B signed up with us. Actually, still has her money with us. 1968, we were the very first company that had a teacher from Cleveland schools enroll in a 403B. So we've had a long relationship, and depending upon the timing of it and the metrics used, we're either the first, second, or third largest company in the 403B market in the K through 12 sector in the country. So this is what we specialize in. Again, we started in 1955 though, so we now have more than 60 years, now 65 years in the business. And that number is a little low. You know, we're encroaching on now $100 billion in assets under management. Part of the reasons why they chose us. To get into, more of the nuts and bolts of the special pay plan. All special pay plans are employer-sponsored retirement plans. It's kind of hard. I'm sharing the screen. Many of you, said you're retiring, probably within 5 years. Most of it was 2 to 3. Many of you are probably already participating in a 403B. Well, the special pay plan is a 403B sponsored by the employer, just like you have now, except that the deposits are done by the employer instead of you voluntarily. Also, Cleveland Schools or any employer that offers this type of plan gets to dictate what is deferrable and what is not part of special pay. Cleveland Schools probably did what most of the school districts that have a plan like this locally for you guys, whether it's Lakewood, Cleveland Heights, Strongsville, I could go on. There are numerous school districts that offer this, but what Cleveland Schools said was pretty much any payout that happens post-separation is going to be included in this plan. And in reality, I think that's the smart idea. Not everyone's done that, but it'll become apparent why that was the smart idea. So again, sick pay, vacation pay, if there's an incentive. Cleveland Schools, for those that may not be fully aware of what is the payout for you as part of the teachers union. Cleveland Schools will pay out to you 30% of your unused sick time. So use your daily rate up to a maximum payout of $30,000. So there's going to be some on this call today that have many, many, many days that, you may sit there and say, wow, I'm beyond the 30,000. Well, the limit is 30. For those a little bit less, then it's going to be the 30% up, to whatever that number is, but the limit is 30,000. What Cleveland Schools also did, and again, I think it's pretty smart. The employer gets to define by group, basically by bargaining unit, or however they want to do it, who's eligible into this plan. Cleveland Schools basically says every single employee, I think there's one of the small unions that's not in, but every single employee that retires, the eligibility to receive unused sick time, forget special pay, the eligibility to receive unused sick time is you must retire from Cleveland Schools, not separate from service. You must, if you retire from the schools, you're eligible to receive it. So what Cleveland Schools is anyone who turns 55 or older in the calendar year that they separate from service is going to be in this plan. So you may be 54 at the time of separation. As long as before December 31st, you turn 55, you will be as part of this plan. And because this is now, the dollars in this plan become an employer-funded benefit, the best example that I can think of is everyone on this call pays into STRS. I know Cindy said there may be a few that pay into STRS, and Cindy has said every year she can't get them to show up. But as you pay into state teachers retirement, you as participants put in 14% of your own pay off the gross into state teachers retirement. Cleveland Schools is also putting in 14% for you. But every penny of that 14% is deposited into the account for you at state teachers retirement. There's no reduction, every single penny. That is exactly how this works. That's, the employer is putting in that 14% as a benefit for you. Well, whatever is due you as unused sick time or whatever the payout is also going to be deposited with no reductions whatsoever. And the importance of the 55 and older is 403Bs have a special provision in them that states that, of course, at 59 and a half or older, the government waives their 10% penalty in early distributions. But if you happen to leave employment in the calendar year that you turn 55 or older, the government will also waive their 10% penalty. That is why Cleveland Schools said, why that 55 and older rule exists. Those that are under, that will not be 55 in the year that they separate, are going to go by the old rules. You could voluntarily defer money into a 403B, 457, maybe some ramifications into that. That's something that could be looked at, but that's why that exists. Let me go past this one. The contributions in this, I will speak to this a little bit. All of the money that goes in, if you were due 30,000, 30,000 gets deposited into the account, fully avoiding all taxes on a current basis. No federal tax, no state tax. Everyone on this call is probably paying into Medicare. Anyone hired before 1986 would not be paying into Medicare, but most on this call are probably paying into Medicare. The 1.45%, the city income tax, all those things are avoided. So you get to maintain control of it. I won't worry about the 5 years because Cleveland Schools doesn't pay out over 5 years. But what's the limit? Well, there's many, and it's hard to see a show of hands because everyone's down on a row on the side. But many of you probably participate in a 403B already. Well, the 403B limit this year for what everyone on this call would be used to for anyone that's 50 or above is 26,000 is what you're eligible to contribute. That's your personal limit. But the total that can be contributed to a 403B is actually 56,000. That's inclusive of employer contributions. So the issue has come in the past is those individuals that were taking advantage of contributing to a 403B and saving additional dollars for retirement on top of the state pension. Actually, probably they were limited on what could be deferred post-separation. Well, now if the school board puts in for you $30,000, you are still eligible to contribute your 26. So you have the ability to maximize the total limit into a 403B. If there was no employer contribution and you were due 30,000, one, you wouldn't even be eligible to put away the 30. It would only be the limit 26, even if you hadn't contributed at all. So one huge advantage is a lot more dollars get to be deposited for you to control and figure out what to do with in the future. Once now and we're going to get into the plan, but what it's deposited in is our portfolio director contract. It has fixed accounts, and there's other slides on it. There's fixed accounts, there's variable funds where you can invest in the market. The main thing is there's absolutely no fee in, no fee out whatsoever. And as soon as the money hits, even if you're 54 at the time of retirement, as long as you're 55 by the end of the year, you can take out money at any time with no government 10% penalty. The only thing that occurs is because the money would be distributed from a retirement plan sponsored by an employer, there is a mandatory 20% withholding. That's not what you owe. Most people would get money back. Ohio does not have a mandate on what must be withheld, doesn't change what you ultimately owe. So you as individuals can determine, what on the state side you want to be, what taxes want to be withheld, or you have the ability to move money to another company. We realize we're exclusive in terms of we're the provider for this special pay plan. Many of you may already have relationships with other financial advisors. If you wanted to move the money, you can move that money to an IRA. I would look at the costs involved, depending if you needed the money. If you happen to be under 60 at the time, IRAs are only 59.5. That's something that, we could help you with and answer some questions. So as I already mentioned, on the deposit, all taxes are deferred until you decide to take withdrawals. But the nice thing is on the second bullet point, those of you in Ohio that are public employees, we don't pay into Social Security, but you do pay into Medicare 1.45%. Medicare is a payroll tax, not an income tax. Your city income tax is also a payroll tax, not an income tax. So the nice thing with having this is, I've heard, well, we don't have incentive pays anymore. Why does this plan still exist? Well, I did a quick calculation earlier on a $30,000 payout. Because the money is going to go into, as an employer funded benefit into the 403B, when you withdraw that money, you will have permanently avoided all payroll taxes. So that's the 2.5% City of Cleveland, 1.45% Medicare. Now that I didn't include, if many of you may live in other cities that you have to pay a little bit more in city income tax, that's a permanent tax avoidance. Even if you withdraw all the money the next day, administratively the next day, that's a permanent avoidance of $1,185 in taxes. That's why that plan still exists. I know most people, $1,200 is nothing to sneeze at. That's a lot of money. What is the investments available? There's about 70 different investments available between a fixed account. Fixed accounts, when you look at the 10-year treasury today, is sitting at about 0.8%. So we're paying a little bit better than that. We're paying at 1.3%, not a huge interest payment. But again, remember the account has no holding period required. So if you compare it to the banks and things like that, which is completely liquid, 1.3% is pretty good, but there's about 70 different variable options, all the way from the very aggressive technology funds, things like that. So you get to determine, and we're happy to help with that, what your risk tolerance is and how long you're planning to have the money in there. You can be in any 20 funds at any time. And some of this I already kind of went over. There's no sales charges, no maintenance fees. You can move money between funds. On the fixed account, it is backed by the claims paying ability of our company, and also up to, it's not FDIC insured, but there is a state guarantee fund for insurance companies that also is backed the same as FDIC of $250,000. I was actually the advisor working with Cleveland schools at the time when this was all started. And it was all, as I was meeting with people, because it was new, I always heard, well, I'm just going to put this in, I'm going to take it out. I'm just going to, as soon as it goes in, I'm going to take it out. Well, I looked earlier today, We currently have under management about $11.5 million in just the special pay dollars through Cleveland schools. What most people are finding is they really don't need the money. Many are withdrawing it, but most, they kind of like where it's at. So the option, you can take money out at any time. It's not within the first 30 days, 1 year, 5 years. It's at any time that you want. So there's no time limit worrying about it. There's some restrictions if you put money into fixed, if you want to get rid of it, but we've waived many of those things. And I already kind of discussed this. When you put money in any of these retirement accounts, you don't pay any tax until you withdraw. But when you withdraw from retirement accounts, you will only owe on the state and federal level. The nice thing is, and this has been adjudicated in the Supreme Court years ago, if any of you, when you retire, happen to decide to move away from Ohio inside of retirement, I want to go to a warm weather state or whatever it may be, there's about 13 states that have no state income tax. And there's many, many more states that do not tax retirement plan distributions. If you happen to move to Tennessee or South Carolina or Texas and Nevada, I could name many more. If you happen to be a resident in that state, you would pay taxes to that state when you withdrew it, and you will have permanently avoided state income tax. It's not necessarily a reason to move, but it's a benefit if that's something where you're planning to move to. So that's something to look at if you are planning to move inside of retirement or have a second home. Make sure that second home, if there's no taxes on the state level, make sure that second home is that you're living there for 6 months and 1 day a year. As I mentioned, we do have a local financial professional, Mike Pasak. He is on this call. We would normally meet face-to-face, but, as Cindy said, just like you guys, we are minimally in a virtual environment into January. My thought is it's going to be much longer than that. As Cindy had said, Cuyahoga County's in the red. The good news is we were able to fully transition. All of our advisors have WebEx. So we can share. The reason we use WebEx is it is a encrypted way to share the information. And that's why we've used that. So we would normally be able to meet at your school, your home, coffee shop, whatever's best for you. Today we just do it over the phone or by WebEx, whatever works. We do have from 8 a.m. to 8 p.m. Customer service, out of Texas. 24/7 online. You can look up the accounts. And again, that can be done on any device, whether it's your phone, your laptop, your computer, whatever it may be. And we do send out quarterly statements. On this slide, I have put out the contact information for our local advisor, Mike Pasak, with his email and phone number. Normally, on these types of things, we always tell everybody, put down your phone. If you are retiring sooner, rather than later, and you want to meet with Mike, of course, you can always call him. But if you take your phone out and put your camera, open up the camera and put it over the QR code, a link will pop up. You don't take the picture. I keep making that mistake myself. A link will pop up. If you click on that link on your phone, it'll go right to Mike's calendar. And you could just schedule a time with him for a WebEx. If that's what you prefer, if you'd rather do it over the phone, that's fine. But we have found that it's, quite helpful to do it. It's our replacement for the face-to-face. And then just a couple things with the special pay, kind of going over Cleveland schools, the rules that they have set forth. Again, we will help you establish the account. You can also do it completely online too. We will help you set up the account. But Cleveland schools, the rule that they have instituted, which does make sense, is they will not pay out the money that's due you post-separation until there is confirmation from us that an account has been set up. the way we just do it, as soon as we, get an application, we just send it over to the benefits office, let them know it's set up. They handle it from there. What Cleveland's, per your collective bargaining agreement, dollars are, the money that's due you is due to be paid out within 75 days of your separation. The school board has done a much better job than paying it out at 75 days. I think, what was it, in 2014 or 2015, when there was some changes in the payouts at STRS. There was a large number of retirees. That was a little, they still met the 75 days, but in the years since then, there hasn't been nearly as many retirees. They're getting it out within 30 to 45 days. They have 75, but they've been getting it out in a much quicker manner. And they would normally notify, they don't notify us when the money comes, but you normally get some type of notification from the board that the money was sent. And as soon as it's sent, we usually have it showing the next day. And then, to get money out, that was the next one. If you want to get money out, there's a cash distribution form, meaning you want to receive the money, in essence, in cash, with, taxes withheld and so on. We can also, there's a different form to transfer the money. Nothing to do if you just want to leave it on file. You can send that directly. There's an address right on the top of the form, or you can send it through, our local advisor who could help you with that. And then normally we process within 3 to 5 business days. Generally, it's a much faster process than that. Our company is getting actually pretty good at this virtual environment. Well, that's the presentation. The one thing I did want to see if I could get to.
We always get the question about how soon should I open up this account?
Okay. Absolutely. It's never too early. I mean, I would think if you're within a year of retirement, that's a perfect time to get it. It's just one thing is, as we saw the presentation from State Teachers Retirement, very informative. And Cindy, going over, that it's very important to do so. There's a lot that goes into the year that you retire. There really is. You retire one time. And it can be very stressful. So this is one thing that if you got it done early, you can just cross off the list. Plus, by meeting with Mike, right now in a virtual environment, we could also even help, as part of the State Teachers Retirement was, going over a budget and different things. I just put one page of what we call a retirement pathfinder. And this one kind of illustrates what a no COLA world, no cost of living increase world. We have to assume in some ways, worst case scenario today, that State Teachers Retirement is not going to bring back, especially with today's interest rates, going to bring back the COLA. If they do, that's great. But we have to assume that they don't. We can help evaluate your budget and things like that. Maybe you're looking at different things. So no cost. It's just something that if you wanted that evaluation done, you can. But I would say you can set it up, within a year. But if you want to start planning ahead of time, even if it's 5 years, we can sit, and virtually sit down and help figure out some of the future things for you.
9.
Any questions? Happy to answer any questions that come up.
Oh, you don't have access to that? How come?
Dean,
You're muted, Cindy.
Yeah, sorry. Dean, I'm going to stop your screen sharing real quick. And see.
Oh, yeah, that's fine. Yes.
And I'm going to say this, for those of you that have the contract book in front of you, it's on page 127 that this contract covers. Before we take questions, I want to remind people that section 1 talks about the retirement incentive. Upon retirement, a minimum of 10 years retirement credit with the district. All bargaining unit members will receive a cash payout equal to the value of 30% of their accumulated sick leave credit. This payout will not exceed $30,000. It doesn't matter if that day was from the first or second year of your teaching. It is based upon your daily rate right now. So I try to tell teachers when they call and ask me, how do I figure it out? Take your daily rate, multiply it by 0.3, do the equals, And if that's greater than 30,000, you have too many sick days. So keep that kind of number in mind. I always throw, Dean and I have talked numbers about the rough estimate. We're not going to put the rough estimate out there right now, but please reference page 124. I am going to stop the recording for some questions. So let me stop before I open up the floor for questions.